everyone. Welcome to our first Century 21 Town and Country Realty Gold Workshops. Today, we are going to be talking with Harrison Walker from IQ Financial. Can't wait for you to hear the great information that he has to share with us. We're doing some Q&As on first-time home buying.
Hey guys, happy to be here and looking forward to sharing some good information about first-time home buying, and we'll go into some general questions as well. So let's get started.
All right, sounds good. So Harrison, what's the first step somebody should take when they decide it's time to purchase a home?
I would say first step is typically consulting with a lender to see what you can afford. Really, it's all fun and games to go find the house first, and that's always the part everyone wants to do. But really, until you know what you qualify for, it's hard to look at houses because you either look at something out of your price range and you got your hopes up, or you might be able to qualify for more than you thought. So I would always say go to a lender first and see what you do qualify for. And usually if you have a realtor, then they'll have good lender connections that they can set you up with.
Absolutely. And I completely agree with you because as a realtor, a lot of times I have people that want to go and look at houses. They think they might be approved for $300,000, for instance, but with the way rates have changed recently, they might only be able to get approved for $150,000. I know that sounds like a big difference, and it is a big difference when, you're looking at a $300,000 home compared to a $150,000 home.
Right.
So, what's the difference between getting pre-qualified and pre-approved?
Yeah, so a lot of people use the terms interchangeably, and really the main thing that people need to know is pre-approval is much stronger than a pre-qualification. I can give you a pre-qualification if you fill out an application and based on the numbers you gave me, you qualify. And sometimes those numbers, they might be fairly accurate or they could be pretty far off depending on what loan program we go with. So the pre-approval actually goes more in depth and it gets the documents to support all of the information on the application as far as employment goes, your income situation, and pre-approval has the eyes of an underwriter and the stamp of approval from an underwriter, rather than a pre-qualification is just me issuing something based on the information that was provided. So really, pre-qual is it's fast, it's easy to do. Pre-approval is going to be much stronger, and there's going to be less surprises if you actually take those steps up front.
And it's really going to give them a better idea of what they can be approved for, correct? Because you're actually going to have income documents that you take a look at, not just going based on an estimated number of hours and pay per hour.
Right. And then there's other things like overtime. Sometimes you can use it, sometimes you can't, depending on length of employment and other factors, but really just minimizes the surprises by getting pre-approved.
Okay, excellent. So what exactly do you look at other than income when you're looking at a loan application?
So there's a handful of things that you're looking at when going through an application, and to hit the highlights, credit score, that's a big one. Income as it relates to your debt to income ratio is pretty important, I would say, depending on the loan type. Now, if you make plenty of money, then your debt to income might not come into play as much. But main things are going to be your credit score that we're looking at, your income, your employment, how stable it is, how long you've been doing what you are doing. And then another main factor is what's in your bank account. If you don't have enough to buy a house, if you don't have enough for the down payment and or the closing cost, then you can qualify for a loan and not be able to buy the house because you don't have the money. So we also look at that to make sure that they do have the funds to purchase the home as well.
Okay, so that being said, so people do need a little bit of money in the bank to buy a house. They can't just get up and buy a house without any money in the bank, correct?
Correct. Now, there are some situations where you might get the perfect scenario. You have a 0% down loan like USDA or VA, and combine that with some down payment assistance or some seller paid closing costs, and you could come to the table with no money. But For the most part, I would say there are few people that end up hitting that ideal scenario.
And I'll add in there, like on my side as an agent, when you submit an offer, you still need to have money for due diligence and money for earnest money deposits. You're going to have money to do home inspections and probably the appraisal up front as well.
Mhm.
Is that correct? The appraisal?
That is correct. You do need the money for the appraisal up front. It does come off the total at the end. So typically an appraisal is 575. So it'll come off your total cash to close at the end, but you do have to pay that up front.
Yes, and if anybody needs to know what due diligence and earnest money is, I'll put a link to another video that I have out on the difference between due diligence and earnest money. That way you can click on that and reference it if you have any questions about that. Now, I know you said something about like first-time home buyer down payment assistance. Is there actually a first-time home buyer loan, or are there just different programs out there to help first-time home buyers?
Yeah. So typically when someone comes to me and they say they want a first time home buyer loan, what we're going to be looking at is something in the realm of down payment assistance. Something that we do a whole lot of is the North Carolina housing down payment assistance for first time home buyers. They're giving away $15,000 and it is fully forgivable if you own the home long enough. So there definitely are perks to being a first time buyer. And a lot of people think FHA is a first time buyer loan. It's actually not, but it is a program that we utilize a lot with that NC housing program.
Okay, so now we're throwing out terms like FHA, VA, USDA, there's conventional. Can you kind of give us an idea of the difference between all of those? And is there any one you feel is better than the other? How does somebody know what's the best option for them?
Yeah, so I would go back to get pre approved. That's the way you're going to find out what your best loan type is. But to hit the highlights, there are four main loan types, and that is conventional, VA, USDA, and FHA. Most commonly, we're doing either a conventional or an FHA loan. And the differences, there are plenty of differences, and we could probably do a whole Zoom call on just the differences between the loan types. But to hit the highlights, conventional is typically for higher credit scores. You get better pricing with a higher credit score. For first time buyers, the minimum down is 3%. For everybody else, repeat buyers, it's 5%. And all these numbers I'm referencing are for your primary residence. Investments and second homes are different. But FHA is going to be geared a little bit more towards the lower credit score buyers because it is a little bit more lenient. So that's a minimum of 3.5% down. Then USDA is a 0% down loan. It does have some restrictions on it, so it's a little bit tougher to qualify for. There are some geographic restrictions. It has to be in a rural area, and their debt to income ratios, they're a little bit stricter as well. So lastly, we got VA, 0% down, no PMI, great loan type for your veterans. But I'll also say that there are times where the VA loan might not be best for a veteran. So always good to get a trusted lender that will walk you through the different products and see which one's going to be right for you.
Okay, great. So now you said something about PMI. Now, a lot of first time home buyers may not know what that is and how that factors into their payments. And then I think with FHA, it's MIP. Is that correct?
Yes. So PMI, and sometimes I'll use it interchangeably with an FHA loan, but PMI is your private mortgage insurance. MIP is mortgage insurance premium, but they're saying the same things. It's an insurance policy that you're paying for to protect the lender in case you default on the loan. So on conventional, if you don't put 20% down, you have PMI. It varies on how much it costs, and it does actually drop off once you hit 80% loan to value, which basically that just means if you buy $100,000 house, as soon as your loan balance drops to 80,000, that's when that PMI will get removed.
Okay, perfect. And then if I understand correctly, with an FHA loan, that the mortgage insurance premium stays on for 11 years, no matter if you pay down under the 80% loan to value or not. Is that correct?
That is correct. And that's for if you put 10% down. If you put less than 10% down, it actually stays on there for the life of the loan.
Okay, wow. See, I did not know that. That's good to know.
Yep, it's good to know, but also keep in mind, and this is deviating from our first time buyer stuff a little bit, but you can refinance an FHA loan into a conventional loan. That way you can get rid of that PMI if you did put the minimum down on FHA. You're not stuck with it for the life of the loan. You're just stuck with it until you refinance or sell the house.
Okay, perfect. So like they say, date the rate, marry the house, right?
Exactly. Yep.
So when somebody gets pre-approved, now they can start looking at houses. Can people get loans on, say, a fixer upper?
Yes. Fixer uppers, there are two main products that people use for that. So on the conventional side of things, you've got your Fannie Mae Home Style is what it's called. And there are some intricate details involved in it, but basically to keep it really simple, they will give you some additional money to fix up the house. So they'll give you the money for your purchase price. You still have to have a down payment, of course, but they'll give you the money to purchase the house. And also on top of that, they'll give you the money for some renovations. That's on the conventional side. On the FHA side, we've got the 203K loan and two different ones to that. There is a limited version, which is more minor repairs and smaller amounts for fixing the house. And then your standard on top of that is a higher loan amount for the repair side of things. You have to have a HUD approved counselor to guide you through it. It's just a little bit more involved, but those are your two main renovation loans: Fannie Mae Home Style and then the FHA 203K.
And those home loans, they typically take a little bit longer to close from start to finish, correct?
Correct. Yes, they do take longer than your typical loan, just more involved with it.
Okay, great. So what about double wides and single wides?
Yeah, so there are definitely products out there for your double wides, your single wides. Let's start with the least common, the single wide. I don't get a whole lot of requests for those, but it is possible now with conventional loans. You can buy a single wide with a conventional loan, no problem. Um, as far as double wides go, double wides, you can do a handful of different products on, but it will be restricted by the underpinning. So if the underpinning is within spec, then you can do an FHA or a VA loan. You can't do a USDA loan on it unless the double wide is new. Also on double wides, you can't get down payment assistance. So, or you can't through North Carolina Housing. There's a separate product that OnQ actually has where you can get it, uh, but it's a lot more in depth. And like I said, on the other question you asked, we'd be talking for 30 minutes on that product. So,
Okay, and that's something we can always touch on another session.
right, right.
Now, I know we talked about fixer uppers, double wides, and single wides. Something else that's really popular right now are tiny homes. Is that something that OnQ will loan on?
Yes, yes, with a caveat. We have to have comps in the area, just like anything else. People ask about container homes, which we can do loans on container homes as well. But there has to be container home in the area or a tiny home in the area that we can pull comps from. And I know comps are a little more your side of things and appraiser side of
Mhm.
things. So can you quickly just give a rundown of what a comp is?
Yeah, so when we run comps, what that means is we're just looking at comparable properties. We want to see, a property that's very similar to the one you're looking at. How many bedrooms, how many bathrooms, is it the same style, same area, and what those homes are pricing at, because that gives us a good idea of what your home may appraise for. And that is part of, once you do find a house and you go under contract, you're going to have an appraisal. And those are some of the things that appraisers are going to be looking at as well. So I guess that kind of moves us into our next step. Once you're pre-approved, you should find the right agent. You need an agent that knows the area, of course, and that has some experience behind them. And you may go with a newer agent as well, but as long as somebody has the support system that they need when they're just starting out. We all start off somewhere, right? So once you've been pre-approved, you found a house you love, what do you do next? We're going to submit an offer, right? So on your end, Harrison, once that offer's submitted, we've gone under contract, what steps do you take on your end?
So as soon as I get the contract, the agent will send the contract to me, and that's when we really get going with things. So if you've already been pre-approved, then you have much less work to do because you've already submitted all the documents that I need. So getting pre-approved also saves time once we go under contract. So another great reason to get pre-approved. But once I get that contract in, I am going to start ordering appraisal, start ordering title work, all the things on the back end that the buyer actually doesn't have to worry about. Those are the things that we're doing during this time. And assuming we already have the documents, we can go ahead and submit to underwriting immediately just to get the first initial review out of the way. We'll have to underwrite it again once we get title work and appraisal back, but it's nice to get that in as soon as possible. And like I said, if you get pre-approved, you've already got that initial underwriting, at least the income side of things, you've got that out of the way. So
exactly. I'm sorry, I didn't mean to interrupt you.
no, that's fine. I was just going to recap on that. So once we get the purchase contract, we're ordering title, appraisal, and we're sending it in for that initial underwrite.
And while you're working on that, on my end, I'm helping you find home inspector. If you've got well and septic, we want to have the well and the septic inspected. You may want to have, a termite inspection. I always recommend all of those inspections because you never know what you're going to find underneath things. And a house may look absolutely stunning, but may have issues in the crawl space or may have structural issues that you just can't see with, the naked eye. So yes, it costs a little bit of money up front to pay for those inspections, but it's very important to get those done. Once those inspections are done, we're going to take a look at that together and we're going to say, okay, what do we want to ask the seller to fix? And that's where, having a seasoned agent, an experienced agent can negotiate for you and, help get those things fixed that are important. So there's some little things, we may say, okay, this really isn't important. You can fix this for $5, and you may not need to do that. So definitely, that would be the next step on my side. So Harrison, how long does it typically take from the time someone goes under contract until they get to close and get the keys to the house?
Yeah, a lot of people vary how much they want as far as the time under contract goes. It'll depend on, as you know, it'll depend on the seller's time frame, and maybe they need to move, maybe they need to find a house, maybe they need a little bit longer. But a good estimate for most transactions, I usually tell people 30 days. Now, I have seen 45, I've seen 60, I've seen even longer than that. But 30 days is pretty typical. And as far as a lending standpoint goes, OnQ will guarantee a closing date in as little as 15 days. So that's probably 15 to 30 is a good range for what most of your transactions will be, with the exception of some being 45, 60, something like that.
Okay, so I've got another situation here for you.
Okay.
I'm a first-time home buyer. I found this perfect house. I'm so excited. I want to buy all this furniture to put inside of it because, I don't have any because this is my first home. And can I do that before I buy the house?
No, you cannot do that. You can do that if you don't want to buy the house. But no, if you end up buying that furniture, now if you have plenty of cash, that's a different story. Spend the cash as long as you have enough left over for the transaction, but please do not get a loan on that furniture. Don't get any loans during the process. Don't open a new credit card unless your lender specifically tells you. Don't buy a car. Don't get anything that would go against your debt to income ratio. So once that goes on the credit report, if you did qualify for a max of, let's say, 250,000, then you add a $500 car payment, you no longer qualify for 250,000. You qualify for a lesser amount. So if you're already under contract, you just lost your due diligence money because you can't qualify for that house anymore. So please do not buy furniture during
Yes,
the
definitely don't buy furniture, don't buy a car, and nothing. Okay, well, what if, here's my last question for you.
Okay.
What if I can't get approved now? Can you help me to improve my credit score or maybe my situation? Give me some tips and tricks so I can be approved in the future?
Yeah, that happens more often than people probably realize. And it's not a bad thing. If you're not ready now, if you can't get approved right now, there are a handful of things that I always will do for my clients. That way we can get them approved in the future. So if it's a credit score problem, we have a what if simulator that will tell you what we need to do in order to get that credit score up to where you will qualify. If it's a saving money issue, then maybe we can set you up with somebody, a financial advisor that will give you step by step. This is how you need to go about saving money. And thirdly, this one's a little bit more difficult, but if you don't have enough income to qualify for the house you want, you'll either have to lower how much you can look for. Like, let's say you wanted that $200,000 house, you qualify for 150. You would either lower it to 150 or you would have to make more money. So making more money is always the hardest part because it is difficult to switch jobs or ask for that raise. So either way, no matter what the situation is, there's always a game plan to approval. So I'll give a detailed email to my clients saying, this is what you need to do in order to prepare to get approved. Typically, it is a credit problem, and those are very, very fixable. So even if you can't get approved now, usually it's worth figuring out what you qualify for before you even start looking for houses. So if you think you're going to look in 6 months, you think you're going to look in 12 months, it's still not a bad idea to get pre-approved or at least get pre-qualified to where we can see what the credit score is and where we need to be and get a game plan for when you are ready to buy, you already know your finances are in order.
And I think that's great advice, and especially having your expectations in line with the market, because let's face it, being a homeowner, it's not all sunshines and rainbows all the time.
Right.
And not everyone, most everyone cannot buy the perfect house that does not need anything at all done to it. Even brand new houses typically have a lot of things wrong on the home inspection reports. So, just keep your expectations in line because there's never going to be a perfect house out there that doesn't need any work or, you know, doesn't have a little quirk about it. But Harrison, I just wanted to thank you so much for taking time to talk with us today. And if you have another moment, can you tell us a little bit about OnQ and about yourself and how people can reach you if they'd like to talk to you further about maybe getting pre-approved?
Yeah, of course. So we've been with OnQ for over a year now, and I've been in the mortgage business since 2020. So I've seen the rates all the way down from the high 1% range to now where we are in the 7% range. So as far as OnQ goes and getting in touch with me, OnQ does have really good programs as far as first-time home buyers go and even all the way up to your investor type loans. So best way to get in touch with me is by phone, 704-685-0601. It's my personal number. Give it out to everybody who's wanting to buy, because typically, as you know, Jennifer, there's times where you have to get in touch with somebody on the weekend. You have to do things after.
Yes.
We're doing this after hours right now. So don't hesitate to call or text if you have any questions at all.
All right, perfect. And I will link Harrison's information in this video for you as well. And then in 2 weeks, on October 26th at 6 o'clock, we will be having another session. If you'd like to come in live and be here in person, we'll be at 2414 East Main Street in Lincolnton. We will be talking about buying and selling in a high interest rate environment. Harrison will be here for that as well. So don't miss it. I will put the information in the comments for you to get registered, but we look forward to seeing you. Thanks so much for watching and have a great day.